All right, closing bell on Wall Street today. The Dow Industrials on a wild roller coaster for the day, really down at one point almost 400 points. But as you can see, recovering somewhat, but all three major indices closing down about 1%. Hi, everybody. I'm Contessa Brewer. Good to have you here. The Dow Jones that closed down about 175 points, recovering from the earlier 400-point drop. You can see 175 points on the day. The market plunged in part because of the falling price of oil. Investors are jittered. They're wondering if this is another sign that the global economy is in crisis. Oil dropped back below $30 a barrel. To help make sense of all of it, Hillary Kramer, editor of GameChangerStocks.com. Hillary, good to see you today. The investors know that China's growth is a problem, that oil is down right now. So why are they taking all of these warning signs to heart when our fundamentals in this country are so good?
Well, there's real concern about liquidity, meaning how much money is out there to pay off all the leverage. There's been so much borrowing to invest, and so many companies, Contessa, they have borrowed money to pay dividends and to buy back their stock. It makes their company look better. Everyone gets big bonuses. So really, we're just adjusting to that. Remember, the Fed took money out of this system starting last year. It's not just raising rates, but not being as manipulative with the cash that they're sending out there, like we're seeing with other countries. And that's just created a problem. And the energy sector's weak. But otherwise, yes, we are stable and the fundamentals are strong.
But there are strategists who are ringing the warning bell. In fact, Citi made headlines just before last weekend because there was a warning from one of its strategists saying the global economy is in a death spiral. That would get anybody's attention, regardless of whether you're making money on day trading or not. But for people who are actively watching their money in the stock market, people who are close to retirement and the like, it would be enough to give you jitters.
Absolutely. And the jitters, though, are more in those growth stocks where is there really proof that those companies are doing well. But you're really buying when you buy a growth stock, even if it's Amazon or Google, now called Alphabet. I mean, it's not just companies like Twitter, which has just been dwindling away their stock price. These companies are really about faith in the future. And that's why we're seeing the dividend-yielding stocks that are hitting 52-week highs are companies like Con Edison, companies like Tyson Foods. We saw companies do well today. Hormel, that makes Spam. Everyone was buying into that company. The stock was up a few percentage points.
What's happening with gold?
Well, gold hit a high that we haven't seen since June of 2015. It hit $1,200 an ounce. And the reason is that it's kind of the go-to place when there's fear. So everyone looks for stocks they can hide in. They go to cash, which is why the market falls. And then, of course, you have those gold bugs out there that start buying up gold.
Are you seeing different sectors getting slammed on different days? One day it's tech, one day it's
yes,
healthcare.
I certainly am. And what I've seen and noticed the most is, and that everyone should be mindful of, especially if you want to see and look for some opportunities, the banks, they've gotten slammed. They've been taken out to the woodshed. Companies like Deutsche Bank had even traded lower than I saw it trade in 2009. Companies like Goldman Sachs was trading in the $145 range today. Citigroup had a bad day. Bank of America was down 5%. So the banks, especially ours here in the U.S., they have really put in a lot of regulatory and compliance changes since 2008, 2009. They are nowhere near failing.
But Hillary, you mentioned something that flagged my interest and concern when you said liquidity is the concern, and are we over leveraged? That was a situation that we found ourselves in leading into the big drop in 2008.
And that's why the market has been down. So everyone keeps saying, why is our market down? Why is our market down? Because we are the strongest, best economy, probably of any economy in the entire world right now. And it's because of those liquidity concerns. Billions of dollars were borrowed to invest and develop oil production and to go out there and to excavate and to to build shale production. And the problem is we have oversupply. So really yes, the issue still goes back to liquidity. It's not just China. Look, China's on vacation this week. It's Year of the Monkey. They're celebrating. Their stock market isn't even open. Now, of course, their currency, the yuan, is still trading. But yes, it comes down to liquidity. And you're absolutely right, Contessa. It was liquidity that brought us down in 2008, 2009. But we saw some good news, which is the market came back so strongly today. I went out there and was looking for bargains as well, and I was buying up stocks that I felt had been hurt.
Because you felt comfortable that those particular stocks had hit their bottom?
Absolutely. Yeah. And that I'm going to make money on them in the short term. And I don't even have to worry because these are the kind of companies I can hold for the long term, too.
One more question for you. We saw the Fed raising rates for the first time in many years. The Fed had said, look, more rate hikes are coming down the pike. Now there are insiders who say maybe not so sure that that's going to happen.
I just don't see where the Fed has any ability to go in there and tighten again. It's just not possible because the Fed can't claim that we have inflation, which is what they would need. Now, they can claim the employment situation's better. We saw unemployment hit 4.9%. We all know that's not true. Everyone is underemployed and underpaid.
Well, in fact, deflation especially with oil prices going down the way they are, deflation might actually be the big concern. Hillary, great to see you. Thank you so much. Appreciate that.